Real estate keeps fueling itself. Low interest rates attract more demand, which is causing property prices to appreciate very quickly, which attracts more attention again and attracts even more demand. Now, if you're a new real estate investor, there's a lot to think about. The first question might be, what should you invest in? If you ask us, we like to invest in freeholds because there's better returns and better cash flows, which translates to better holding power. And if you want to learn more about that, check out this video first. So if you're convinced that freeholds are better, then your next question might be, where should you invest in? Historically, Toronto is more expensive, so if you can't afford Toronto, you would most likely have no choice but to go outside of Toronto. But the pandemic has really made things more equal now, with other parts of the GTA appreciating much quicker than Toronto. So given that the entry price for properties are now more or less the same, where is truly the best location in the GTA to invest in? In this video, I'm going to do an investment return comparison between Toronto and Pickering freeholds. I picked Pickering because of its impressive appreciation over the past year. Pickering has seen a whopping 43% appreciation year over year as of March 2021, whereas Toronto has only gone up by 10% year on year. Specifically, I'll walk you through how historical long-term returns compare, how returns have changed over the past year, and give you some insights on where returns might head moving forward. If you like this kind of content, please remember to give us a thumbs up and don't forget to subscribe to our channel to see more videos like this made specifically for real estate investors in Toronto. In the simplest terms, real estate returns come from rental income plus appreciation. And if you ask, what about your mortgage? Well, if you factor in a mortgage, on one side, your expenses do increase, but on the other, more significant side, this improves your leverage. So the net effect is that your total returns actually look a lot better. But if we're looking at returns as a percentage, if returns before leverage are better, and the leverage multiple for different properties are the same regardless of location, then post-leverage returns are directly correlated and will automatically be better as well. So let's simplify our comparison and look strictly at returns before leverage. Okay, let's take a look at appreciation first. Based on TREB numbers, the earliest data for Toronto and Pickering on TREB is from March 2012. So let's take a look at historical appreciation between those periods. Over the 8-year period, we saw an average annual appreciation of 7.6% for Toronto and 8.1% for Pickering. Now, Pickering is still at the growth stage, whereas the majority of Toronto has matured, so that's why Pickering does see slightly higher appreciation versus Toronto. Then the pandemic came and Pickering knocked it out of the park last year with 43% appreciation, whereas Toronto only saw 10% appreciation as a whole, which is good, but not nearly as good as Pickering. Now, if you factor in leverage, this difference is even more massive, and congrats to you if you own property in Pickering over the past year. Now, given the impressive appreciation last year, what will happen in the future is entirely subjective. Pickering's appreciation probably won't be 43% per year forever, and if you believe that Pickering has already overextended itself for the next 4 years, then we might see much slower than average appreciation for the next few years. This isn't the case in Toronto, so we'll most likely see more stable appreciation here. There's also the recovery story, where Toronto will likely benefit from more job growth opportunities and people moving back to Toronto because of this. Finally, there's more public and private development focus in the core, so gentrification potential in Toronto can also be higher once Pickering starts to mature. Unlike Pickering, which might see low rates of appreciation in the next few years, Toronto's appreciation might dip a lot less than Pickering simply because Toronto didn't see as much appreciation last year. Toronto's appreciation went up 2.4% more than average last year, so you can argue that maybe in the next few years, appreciation might be 2.4% lower in Toronto spread over 4 years. In other words, instead of 7.6% annual appreciation, we're looking at around only 7% annual appreciation over the next 4 years, which isn't bad at all. Now let's look at rent yields next, and we like to use the metric cap rates, which is basically our net rents as a percentage of the property's market value. If you do want to learn more about cap rates, you can check out this video here. Before the pandemic, Toronto's cap rates were better than Pickering. In February of 2020, cap rates for Toronto freeholds that we invest in were closer to 5.5%, whereas Pickering's average cap rates were close to 5%. As a side note, cap rates were better in Toronto because renters are willing to pay a premium to live in Toronto. Now let's see how cap rates changed after the pandemic. Toronto rents dropped by around 20% and property prices went up 10% over the last year. So the new Toronto cap rates are lower, sitting at around 73% of the old Toronto cap rates pre-pandemic, or currently at around 4%. Now on the Pickering side, even though rents didn't change much, property prices skyrocketed 43%. So now Pickering's cap rates are also lower, sitting at around 70% of old Pickering cap rates, making a new cap rate of 3.5%. If you invested in Pickering last year, you might be like, it doesn't matter how cap rates did because appreciation was so awesome. The rents aren't really that significant. That's true, but I found that the cap rate adjustment is actually very interesting because even though appreciation and rents moved at different directions and paces in Toronto versus Pickering, the net effect to cap rates post-pandemic were very similar. So having said this, Toronto cap rates will most likely remain at the same percentage higher, even if rents and appreciation changes in the future. In other words, Toronto's cap rates will likely stay consistently at around 0.5% higher than Pickering, even if appreciation or rents change. Now that we have all the parts, we can look at total returns. Based on historical numbers, Toronto's appreciation is at 7.6% and cap rates were at 5.5%, so total returns was at around 13.1% pre-pandemic. Pickering's long-term annual appreciation is at 8.1% and cap rates were at 5%, so Pickering's total returns were also at 13.1%. From a total return standpoint, the two cities saw the same awesome total returns before leverage. Pickering's appreciation was 0.5% higher, but cap rates were 0.5% lower, so the two cancel out. Now, you might be more concerned about where things will head moving forward, and again, this is highly subjective. We mentioned Toronto's appreciation might dip a bit to around 7%. And if you assume cap rates will stay conservatively at 4% per year, then we're looking at 11% total returns per year in the next few years for Toronto. On the Pickering end, if we're expecting really low appreciation rates, say 2.5%, and cap rates that are 0.5% lower than Toronto at 3.5%, then Pickering's total annual returns would be at 6% per year over the next few years. This 5% difference, when you factor in leverage of 4 times, would be a 20% difference. So this makes Toronto's investment returns a lot better than Pickering. Again, nobody has a crystal ball, and these are just projections based on our own assumptions and views. Actual returns moving forward will differ based on where actual appreciation and rents will go, and it's important for you to do your own analysis before making investment decisions. Besides number crunching, we do have a few more insights to share. First of all, both cities have great long-term returns, and it's hard to go wrong if you hold them for the long haul. Pickering has been in a growth stage in the past, and that's why we've been seeing higher appreciation in Pickering. Once it becomes more developed and more mature, we might see growth slow down a bit to Toronto's average appreciation rates. And if you look at Toronto, different pockets might have different appreciation rates. So if you choose neighborhoods undergoing gentrification in Toronto, then you'll see higher than average appreciation rates in those areas. Another thing to consider is active management. If you do decide to manage your rental properties on your own, living closer to your properties can reduce total travel time and total active management time. So this is another thing to take into account. Finally, remember there can be differences in tenant profiles. Suburbs tend to have more renters that are families, and families tend to stay for a longer time. On the other hand, core Toronto sees less family renters, meaning they're more transient. Now, if you combine this with the fact that market rents increase at a much faster rate than regulated rent increases for existing tenants, you're able to have better returns if you have tenants that turn over more regularly versus tenants that stay for a long time. We at Elevate Realty are a full-service real estate investment brokerage specializing in properties in Toronto. When you connect with us, we take the time to learn about your requirements and preferences so that we can find you the best performing real estate investments for you. Once you buy a property with us, we can also guide you through renovations with optional services for leasing and property management. If you want to learn more about our services, please feel free to reach out to us by heading to the link I'll put in the description below. And if you want to get more frequent updates about real estate investing in Toronto, look for us on Facebook, Instagram, or LinkedIn. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye.